Here's how to find out how much a bank will lend to buy a business. So banks really rely on the actual tax returns of a business to decide on whether they're going to lend. They really don't put a lot of weight in a P&L that's provided by a seller. The general idea is that people don't overstate their earnings on their tax returns because it means they're going to have to pay taxes on it. And you can put anything you want in a P&L. So here's the main section of a standard US tax return. It can vary a little bit by structure, but they're all pretty similar. So you want to go straight to the non-cash items here, or the things that aren't going to carry over to you as the new owner, including the previous owner's salary. So I like to start with the bottom line, which is the ordinary business income, and then add back things like officers' compensation, interest, and depreciation. And in this example, which these are just random numbers, it's not related to a real business, the net income is $999,000. The officer's compensation was $120,000. Interest was $50,000. And the depreciation was $500,000. So adding that all back, our cash flow is $1,669,000. And then next, you'd want to check for any personal expenses that they're running through, like a car or insurance or any other thing that they're running through that they shouldn't be. Their travel's pretty common. In this example, we're just gonna say there isn't any, but under the line that says other expenses, there's gonna be a reference to either like a statement 1, 2, or 3, any number, and you'll be able to see more detail there and try to pick out the personal expenses. Then next, you need to subtract out your expenses, and the bank is gonna require this. You need to subtract your new salary, and that's gonna be based on your personal expenses. If you drive expensive cars and live in a big house, the bank's gonna say, you need this much money to maintain your lifestyle, and they're going to subtract that from the cash flow. If you live a pretty frugal life, you don't have any debt, you don't have a lot of expensive things, they're going to make that a pretty small number. The minimum is $25,000. Then you have to subtract the capex. That's just the amount of money that you need to spend on new equipment each year to just keep the business running. So think of trucks, machinery, anything that business needs to operate that's going to get essentially consumed over a long period of time. So this example, we use salary and $100,000 a year in capex. So our cash available for the debt payment is $1,419,000. And then we can use this to calculate the maximum loan that you can get. So the absolute minimum, what they call the debt service coverage ratio that you can use to buy a business is 1.15. So that essentially just means that the cash flow that's available to pay down debt is 115% of what the loan payment is. And you can back into that payment by dividing your cash available for debt payment by 1.15, or the debt service coverage ratio. And that gives you the payment that you can make. So in this example, the absolute biggest payment that you can make is $1.2 million a year, which means you can buy a $7 million business or pay $7 million for this business. Now, there is no way, absolutely no way I would ever do a deal at a 1.15 coverage ratio. You're not making enough money to be worth your time. It's entirely too risky. Like, the odds of you going to bankruptcy court are just way too high for me. There's no way I'd do a deal at that level of coverage. I think what's more reasonable for a larger deal like this is somewhere between 1.5 to 1.7 times. If it's a smaller deal, say it's $1.2 million purchase, I even want it closer to 2. And generally, the debt service ratio that you should be willing to take on should be based on how risky the business is. The higher risk, the higher the coverage ratio, so that gives you a higher margin of error. If it's something really steady, then you can go for something on the lower end, but I wouldn't touch anything below 1.5. So in this example, at 1.5, the maximum value I would finance would be $5.4 million. Then here are the formulas for the previous page, just for those playing along at home. And then for the present value calculation, I just always use the Excel function, which gives you the how to use it there. If you don't want to use Excel, just Google present value calculator.